Hello, everyone. Can you hear me? That's great. So first of all, thank you for joining us. I know everybody's hungry, so we'll try to be as efficient as possible. So my name is Dani Goldsher. I'm the CFO of Triventures. For me, it's a special day. I guess for all of us here, I think it's the first time in the last 2 years that I just jumped on a plane. And it's to see everybody here and meet face to face. It's pretty awesome. So, you know, a decade ago, money talked. Investors had the power to decide when to invest, what amount to invest, and to set the terms. But these days, things are quite different, at least how we see it. And more power lies not only in the investor's hand, but also in the founders and the company's hands. It's a clear trend of shifting power from investors to the companies. Terminology such as full ratchet, participating preferred shares are almost not relevant anymore. And VC and venture capital and private equity are quickly adapting. And I mean, they have to, all of us. And they do it by value creation for portfolio companies. For example, at least what I've heard, the Sequoia Fund has approximately 250 professionals that dedicate their time to value creation in portfolio companies. So in today's discussion, I would love to elaborate what we see in our venture capital, mainly in Israel and in the US in early stages. And our experienced panelists here will elaborate more about what they see in Europe and maybe in later stages. But before we start, let's do kind of a short introduction. Go ahead.
Yes, Gert-Jan Huijbers, CFO and head of ESG at Parcom Capital. We're a mid-market buyout fund predominantly focused at Dutch companies.
Stephanie, some of you might have seen me on the panel earlier, but this one was actually planned.
She's our serial panelist.
So head of ESG was Altor Equity Partners, which is a Swedish private equity firm, and I think we'll speak a bit more about, but for us indeed kind of ESG is kind of based in the value creation team, and I think that's where it belongs. And in terms of background, I've dedicated most of my career to sustainability, mostly in management consulting with McKinsey and Quartz, but also in the non-profit world with the Ellen MacArthur Foundation. And I think that the common thread has always been to seek to reconcile the economic objectives with the environmental and social objectives.
Toine Huijbers, I'm CFO of DB Equity. And we are a family-backed impact investor, and we have an office in Nairobi, and we focus on East Africa.
Nice. So as I said, I'm Dani Goldsher. In the past 15 years, all I do is finance, among others, and guilty as charged, I'm the CFO of Triventures, which is an early stage and mid-stage venture capital. We invest in startup companies both in Israel and in the US mainly. We invest not only in digital health, but also in the convergence between technology and healthcare verticals such as fintech and insurtech, cyber, e-commerce, and others. We manage around $200 million assets under management. One thing interesting about our fund is our strategic partners, strategic LPs, that later on I will tell you how it connects to value creation. So going back to our discussion, I want to give you an example from what I see in Israel in the past. In the first 6 months of 2021, two pretty amazing things happened. One thing is that $12 billion was injected or invested in technology companies in Israel, and which is an all-time record. And the second thing is 24 new companies were announced as unicorns. So of course, maybe it's all about or some of it is because of the maturity of the companies, but a lot of it is because of the large amount of money that was poured into this space. And what we see, at least in Israel and in the US, that it is definitely a company's market. Sometimes they even set the terms, and this is what we see. And it brings us to the first question: is in later stages, European firms, if you see the same thing, that it's a company's market?
Well, for European companies, I cannot comment, but
Or in Africa?
In Africa, in Africa, what we see is that a lot of money comes in, new funds every month almost. I see the same things. Valuations go up, and if you want to be there and active, then you need to bring something else on the table than money.
Definitely smart money. So we all agree that valuations are high and it's a company's market, and that basically that to do value creation for the portfolio companies is crucial. And maybe in the good old days, value creation was defined, let's say, as an X, maybe support in exit transactions and M&As. But what is this Y? What is this? We call it a value creation 2.0. Do you have an? Yeah, go for it.
No, I think that's indeed kind of what we also discussed a bit earlier on, kind of what is a way of looking at value creation and looking at value creation beyond pure financial value creation. And I think that is a key thing that has changed kind of the realization that kind of that you don't have to choose kind of between one over the other, but kind of that focusing on all elements, also kind of the social and environmental elements, will ultimately lead kind of to future-proofing your businesses and to having a strong financial performance.
Yeah.
And therefore also it doesn't require kind of to turn impact investor, at least kind of as Altor, kind of we're not impact investors, but what we strive for is to say kind of we want to invest with impact. And what that means is that we really go for kind of that it's a bit of an old-fashioned word, but for that triple bottom line approach, we really say kind of throughout our ownership period, kind of we want to, as also my co-panelist said earlier, leave the company in a better state. And that means kind of that from the outset, kind of you also plan kind of how do you want to build social and environmental capital throughout your ownership period, and how can you be part of the transition? And I think the tricky bit is not to say kind of we only invest kind of in the ESG winners, for example, but it's to say kind of how can we play a role in being part of that transition and making a difference, kind of by the way kind of we engage with the companies in our portfolio.
That's great. Yeah, I can say from what we see, an interesting financial figure that maybe some of you are familiar with is that in the US. In the US, there is a phenomena. Approximately 18% of the GDP goes to healthcare expenditure. Think about it. It's more or less almost a fifth of the US economy is healthcare. And this is where we in Triventures are focusing mainly. And just for the comparison, the average in the OECD is approximately 10%. So, and this healthcare system in the US is a big mess. I'm sure you're familiar with it in some ways. And together with our strategic partners and with our partners that are located in the US and in Israel, which they are very familiar with this system, we help our companies just to avoid hitting walls and to sit with them out of the boardrooms and help them do strategy sessions to be able to choose the right path. Another thing that we are doing is lately we collaborated with the biggest medical center in Israel, Sheba Medical Center, and they have a very, in the past oil companies were the biggest companies in the world, and today data companies are the biggest and most powerful. And our portfolio companies and the startups we work with need the data in order to do pilots, to work with this data. And through this partnership with Shiba, we give access to the portfolio companies to make pilots. And this is kind of the value creation 2.0 that we see. So we understand that there are various ways to create value, but to create value creation, to measure it, for me it's kind of, I don't know, it's very amorphous, it's very difficult. But do you measure value creation? Do you, and if you do, how do you do it?
Well, it's, I can explain how we implemented that at the Parcom. I think everybody recognizes that if you looked at funds maybe 10 years ago, it was a lot about financial play. And you buy cheap, you sell expensive, you do some working capital improvements, sale and lease back, and that's how you make your money. I think private equity markets became a lot more mature, prices went up. Also the sellers are a lot more educated, so you need to bring something else to the table to be able to win those deals, and you also need to prove that you can do something with those companies, and therefore you need to measure that you can add value to companies. So what we've done in the past years is well, I think everybody knows the 100-year plans, but actually put figures alongside those 100-year plan or 100-day plans.
Speaking about longer
Yeah.
periods.
But actually, when we define in our investment cases how much value we aim to add, and where we say, well, okay, we think we're going to make 2.5 times or whatever. We define exactly what's going to contribute to the additional or to that value creation, and that can in part be simple revenue growth, but also the value creation initiatives are specifically defined, and we add part of the multiple to each of these initiatives. We've installed a separate operating team that's actually like an in-house consulting team that helps our portfolio companies to define the projects to achieve that value, and also to help them measure and track value creation. And we've installed a tool which, well, it's called Amplify. I think it's a fairly small company. It's a bit similar like what people that worked in project management in the old days, like MS Projects, where you can define exactly which steps are required for each project, each value creation project. But you can also establish a zero measurement, and then track which elements of the company you want to improve, like additional revenue on certain products, or less cost on certain items. And that's the way how we track projects alongside those financial metrics. And in the end, what we want to use it for is that also when we talk to investors in the next fundraising, that we can actually show them and prove this is what we planned with those companies, and this is what we have actually achieved with those companies through these projects. And I think that's going to be more key at least in the mid-market, that you can actually prove that you can add something to companies, and that you can demonstrate how you've done that in the past. And that's going to be an addition next to your normal track record.
Fascinating. Yeah. Yeah, so my next question is, these days many funds and private equity are talking about ESG. You also talked about it in the previous panel, but again, Stephanie, as the head of ESG at Altor Equity Partners, how can ESG be integrated to create sustainable value?
I mean, first of all, it's really about thinking it kind of throughout the entire ownership period. So making sure kind of that it's something that is clearly in focus already at the screening and sourcing stage. I spoke about it earlier, saying that in the due diligence, making sure kind of it's not only looking at the risk, but also clearly looking at the upside, and then ensuring that it is part of the 100-day plan and the value creation plan from the outset. And then kind of we kind of have the luxury as a private equity firm, obviously, that we're not that much driven by quarterly reporting cycles, and that we have longer holding periods. So we can also be, and we usually have majority ownership, meaning we can also be quite active owners and support our portfolio companies in working with these concepts. And I think in terms of successful ESG integration, what it really comes down to kind of with portfolio companies is materiality. So really focusing on those themes that matter to the stakeholders of that business, and where the company can truly incredibly make a difference. And that also then means point two, kind of that it is fully integrated with a business strategy. So I really don't want to have any company kind of where there is a business strategy and a sustainability strategy. It should always be kind of one thing. And then third is exactly what you said, it's a measurement. And for example, we have rolled out a rather comprehensive and quantitative ESG performance monitoring as well, because to me, kind of, if you don't measure the progress, then you also won't be early enough to detect kind of if things are not on track. And therefore, kind of we basically have set similarly high standards on the non-financial data than we're setting on the financial data.
It's amazing, yeah. That's great. So all of us here, some of us in private equity and some in VC, early stage and late stage, I'm curious about what's the differences between value creation in venture capital versus private equity? Can you see the difference, or for example?
I see what we do in Africa is venture capital. Obviously, we invest really early stage. We provide catalytic capital, often the first institutional investor. And I think we are very hands-on. So sometimes, if you, especially when the crisis started last year, and liquidity was the main important thing for a lot of companies. Some did okay, but some were okay. What to do now? So then we actually helped them making a cash planning, or made sure that there was some consultant doing that. So I think in venture capital you have to be more hands-on than in private equity. But private equity.
Yeah, I think if I compare it, where I see that you have to help venture capital companies to grow. I see if I look at the companies we invest in, they're established companies that earn profits for decades. And so it's more about education, and you need to change behavior. So, for example, also when we look at ESG with companies, it's a lot about education and letting them. Real entrepreneurs always think 5 or 10 years ahead. So in part, it's already in their brain, but it's. If they need to change what they've been doing the past 10 years, it's change management. It's a different way of creating value compared to where you actually have to help a company grow. And so it's more that the teams, there needs to be a real click between our teams and the management teams of the companies, and they work very close together. But it's almost more like a coaching role that they engage in than like a consulting, or they really help them. So it's the management teams need to do it, and we try to coach them in the right direction.
Yeah, nice. I can give an example from Israel in the healthcare space. For example, we in Triventures, back in 2009, there was no ecosystem, there was no mentorship, no VCs, that venture capital that invested in healthcare startup companies. And what we wanted to do, we understood that we need to bring a model that will bring the globalization or the globally value creation to the Israeli entrepreneurs. And we're proud to be partnered with strategic partners in the space, such as Johnson & Johnson, Boston Scientific, Abbott, and when we reached the digital health space, so also Samsung, and we understood that we need to have also from the US market hospitals and health insurance companies, so we brought also Intermountain Health. And these strategic partners helped us to build an ecosystem and to really help the companies to mature. And of course, we had to, part of it was to open offices in the US and in Israel. We have partners there as well. And the work with the strategic partners is pretty amazing, because they can be customers. We connect them, of course, with the portfolio companies. They can be customers or design partners. And then they can be also an investor and a potential acquirer. So we see it as very valuable to work with the strategic partners, especially in the VC, in the early stage companies.
Maybe just to add one thought to that.
Yeah.
I think it's also an interesting development, and that I think traditionally there were quite clear lines, and you could differentiate between venture and private equity by size, by technological maturity, by business model maturity. But I think nowadays, especially with the green transition, it's kind of, first of all, I think there's hardly any company that is not in some shape or form a tech company. And then with the green transition, I think you have a lot of new technology in established industries. So you have kind of a new category of very kind of asset-heavy technology players, and I think that is an interesting field to navigate, because it's also a range of companies that very soon goes from too small to too big if you're in the private equity space. So and I mean, we do mid cap, so I think it's a super interesting space to observe and kind of finding kind of the right moment to enter.
Yeah, definitely. So I think we're closer to the end, so I would like to invite you to kind of do an very short executive summary with your important takeaways from this session. Gert.
Well, as said before, I think, and even one step back, I think where Dani started, that in this space, there are a lot of buyers and fewer sellers. So it's a seller's market. Management teams we engage with want a new shareholder that helps them transition their company and makes them grow. Whether it be ESG or whether it be value creation, that's what they select companies on, and they check their references on what you've done with other companies. They simply call other owners, and I think that's going to remain key in sourcing.
Actually, I would be much more interested to hear the takeaways from the audience, but I'll still give it a shot. I think indeed, kind of coming back to that initial theme of it is a company's market, and clearly, kind of as an investor, you need to add something to the table. So the kind of companies you invest in, they need to see a value in bringing you on board, and I think that is something that we've seen quite clearly. Kind of that there were cases kind of where kind of we got in despite kind of knowing that we had the lower offer, because there was something about the track record that we have in working with founders, the kind of track record that you've built up in terms of certain sector competences, and then similar to what you mentioned, kind of we have also built up what we call the value creation team, kind of where we have kind of the ability to really build world-class competences in certain functional areas. So for example, also in talent and procurement and in finance, and I think that is something kind of that then kind of your portfolio can benefit from.
That's great.
Yeah, I think what we saw is that we do impact first. So we do first look at the impact of the business itself, and after that we look at the strictly business case and look for long-term profitability. And what we learned is, and also what I take away from this session, is that, for example, if we invest in plastic recycling, then we also look at that company from an ESG aspect on all different aspects of ESG. So, and especially what Gert said is about, you also track it, so you can show proof to your investors, but also to potential new investments that you have a track record on that, and then you can prove it with data. Yeah,
super interesting. I must say that in general, to do impact investments in Africa and working with ESG, it's like double ESG, double impact. It's like pretty amazing. So that's awesome. So thank you for the enlightening remarks, and allow me also to conclude. So as everybody said here, we're living at times where valuations are skyrocketing. But we believe that this unparalleled amount of money that is poured to the market, of course, will come to a stop, and this halt will present a massive challenge for the portfolio companies. And the question is how today we will take and do creative value creation to the portfolio company, that they will be able to reach the next phase, which will probably be more challenging, and to maintain and to still be growing and to be strong portfolio. And so I guess keep on doing creative value creation, and thank you all for participating. Do we have time for questions?
Hopefully.
Yeah? Okay, great.
Okay, I do have one.
Go for it.
So you have said, rightfully so, if you can quantify this work stream has increased value of the company by this much, then for your future fundraise, it's amazing, because it's fact, it's hard fact. And now it's probably more for Stephanie, but okay, the environmental, perhaps you can see a clear link. I've reduced wastage and I've saved this much cost. How do you prove that for the social aspects? How do you quantify the value creation that's linked exactly to this?
I mean, that is clearly a challenge, because there is no kind of immediate link that you can always establish. Because as I say, kind of on the environmental topics, if you're more energy efficient, if you're more resource efficient, you can bring down your cost base. On the social dimensions, I think there are some elements you can think about. For example, if you are really good in managing or in developing employees, in attracting talents, you'll have a high employee satisfaction, you'll have a higher productivity, right? You might have less churn. If you are really well in managing diversity, kind of you broaden your talent base. So I think it is softer categories to think about for sure. but luckily also increasingly kind of those categories get a little bit hard-coded, and I think there also regulation is coming our way, right? If you think about fair labor practices, human rights topics, kind of, for example, with the new EU Supply Chain Act, I mean, there's some of those things kind of that get more tangible, and that is another aspect. I think really think about this as future-proofing businesses and some of the environmental aspects, some of the social aspects. It's also increasingly something that helps companies to win tenders. So it's in some aspects, it's also just to say it might be nice to have today, but it will be kind of a need to have tomorrow. And therefore also on some of the topics, again thinking environment, for example, if you can bring down your emissions more than your competitors can, kind of, and the carbon price starts increasing, you just have that competitive edge that is harder for kind of your peers to catch up with at that point. But yeah, it's no kind of direct science, because it's so many factors that I think it will be hard to establish a model. What you can see is kind of that there's a growing body of research kind of that shows kind of a correlation between high ESG performance and high corporate financial performance. But obviously you have the question of what is correlation, what is causation, and is it the high-performing companies that then focus on ESG or the other way around, right? But clearly also, I mean, looking at that research and also looking at the fact that we see more and more kind of ESG or especially green exit premiums, there's, even if you're a complete cynic, kind of there's little reason not to work on these topics.
And to add to that, where we see that also the S and the G directly contribute to your bottom line is that we're more and more in talks with banks that want to link ESG criteria to their loans, and if you have show progress on the E, the S, and the G, you get a discount on your loan.
Nice.
I have something to add. If you look in investments in Africa, in the European Union, you have subsidies from your country, from your government, from the European Union. In Africa, the companies more rely on grants from foreign countries. And if you have a lot of ESG aspects in your company, then you apply for a lot of grants funding. And in that aspect, you can even check which grants you attract as a company in Africa. Yeah.
Thank you
so much.